Hi, everybody. Welcome back to another episode of the Discovering Multifamily podcast. I'm one of your hosts, Anthony Scandariato. And today we have a special guest with us, Ryan Condie, who is a small business buyer who focuses on acquiring, growing, and holding it's primarily internet companies, right, Ryan? From 200,000 to about a million in EBITDA. And he started 8 projects, and he bought two companies and both succeeded, and he can kind of talk about that. And he's also the host of the Let's Buy a Business podcast and has seen a lot of deals and has done a decent amount of deals. And we want to hear all about them and also explain to us the differences between buying an apartment building versus a business. So I really want to hear about this and looking forward to educate my listeners and myself. So Ryan, thanks again for coming on the show.
Thanks, Anthony. Appreciate it. It's fun to be here.
Sure. So tell us what's going on. I was actually just on Ryan's podcast, and he started telling me about a candy company he helped found and a couple of the deals that he was working on. So what's going on?
I can give you a little bit about my background. So I spent 8 years in software sales. Salt Lake is a big tech hub. And kind of in between all of that, I've always had different projects. And a couple of years ago, I started a candy company. Totally different than software, but we applied what I learned in software and applied it to candy, and we were able to scale to about 700 wholesale accounts in the first 12 months. And you can now find it's called Blue Moose Sweet Shop. You can now find it in Sam's Club and Walgreens and many other stores across the nation. Ultimately, I left that. It was a family business, and if you've ever worked with family, Anthony, you kind of just have to do it once to realize, like, probably not the best fit long term. I learned a ton. I had a lot of fun. And I've always built e-commerce companies. And so some of these have been on the side, some of them have full time. And over the past couple of years, I've bought two e-commerce companies, and I've built one of those, and I decided to go full speed ahead in just the acquisition space. And I launched a little podcast, Let's Buy a Business, to kind of document my journey of how to acquire a company. And I didn't get an MBA how to do this. I don't have a private equity background or anything like that. It's all kind of self-taught through podcasts, through YouTube, through just doing it. And to me, I've started a lot of companies. Some of them were great. Some of them weren't very good. Most of them never made any money. And I realized that the companies that I bought, it had product market fit, it had profit, it had customers, all the things you don't have when you start from scratch when you have a company. And I realized I had a lot more fun and a lot more energy. And so I've really just focused on how do I get past the first 4 to 5 years of a company, or even 10 years of starting that company, come in where there's profit. And then I can take my background of sales and partnerships or e-commerce and internet marketing and try to grow those.
That's awesome. So you've had some experience with real estate too, correct?
I bought my house. When I was in college, Anthony, I did mortgages, and I was not very good at it. I probably should have stuck with it because my mentor and my boss, he owned about 60 houses. And I think at this point he owns 120 houses. And it's just incredible what he's built. And I look back, and I didn't use that time with him very wisely, but we're in the process of buying our second home and renting out our first. So not necessarily multifamily, but definitely on that second property.
Awesome. So can you kind of talk to us how you're evaluating businesses to purchase and kind of how that's different from evaluating real estate, or is it different? Can you kind of talk about that process? What do you look for in companies? How is it different from what you're looking at in real estate? What can you talk to about the evaluation process?
Yeah, absolutely. So a lot of times people ask, is this a good business? It's a bad business. And a lot of times people think if it's for sale, it's just a bad business. That's absolutely not the case. A lot of times entrepreneurs, they're tired, they're bored, they're ready for the next opportunity. Or they've been doing the same thing for 5 or 10 years and they're ready for a change of scenery, or they want to take a big chunk of money off the table, whatever it might be. So when you evaluate companies, you typically want to find, start with your lifestyle. What's your ideal lifestyle, and kind of work yourself backwards. If you want to stay in New Jersey, you can look for local companies in New Jersey, right? There's probably some really amazing, very profitable HVAC companies, plumbing companies, service companies. But if you are open to any region, you can get very specific on, I want to be in a certain niche, right? A certain industry. Or if you're very specific in one area, such as my background's in online companies. It's e-commerce, it's content, it's SaaS companies. So Anthony, I typically look at online companies. And the thing with online companies and internet companies is you can move those forever. So I'm in the process of buying a company in California and moving it to Salt Lake City, where these deals, you typically want to look at your skill sets, right? So you're taking your ideal lifestyle and working yourself backwards. But in addition, your skill sets, if you're really strong on the operations, find a company that's really good at marketing, but not very strong on the operations or the numbers, or vice versa. If you're really good at the sales and marketing side or the internet marketing, look for a company that's really strong operationally and has a good foundation that then you can apply your skill sets to stack on that and grow it. And that's typically what I recommend. A lot of that's just some introspection of, what have you done in the past? What do you like doing? And of course, what problems do you want to solve? So one thing you'll find, Anthony, and I'm sure you see this with multifamily real estate, is there's something about that property you don't like. And a lot of times there's several things you don't like. There's no perfect property. There's no perfect business out there. Even businesses that I've created myself, there were parts of it I didn't like. So you just need to figure out, are those the type of problems within that business that you are, one, comfortable with solving, and two, you want to solve. You might be able to solve them, but you don't want to. So then you can pick on a different business. I actually looked at a couple different local franchises about, 5-6 months ago, totally different than my online stuff that I was looking at, Anthony. But I ultimately passed on these businesses because the majority of their employees were 16-year-olds with an 18 to 19-year-old manager. And at this point in my life, I just didn't want to deal with 16-year-olds. Maybe that's different down the road, but at this case, I just decided I didn't want to solve 16-year-old problems and, all those sorts of things. So there's a lot of ways to unpack it, but a lot of it is going to be based on your skill sets and which types of problems you want to solve long-term.
Got it. And how do you go about finding these businesses to buy? How is it different from finding a real estate multifamily property? How do you find these deals?
It's actually really similar to real estate. So with real estate, you have the MLS and you've got real estate agents. It's very similar with online companies or even local companies that are for sale. You're going to have brokers that you work with. So whether you're looking for online, whether it's local, there'll be local brokers who focus on selling those businesses. Now, to be honest with you, a lot of brokers are very similar to real estate agents, where about 90% of them aren't very good, but the 10% who are good are really, really good and definitely worth their weight. When it comes to finding them, it really kind of comes back a little bit of what you're trying to look for. And so if you're looking for those local businesses, there'll be local brokers and brokerages that focus on, say, New Jersey or Denver or Florida or wherever you want to end up. Now, if you're looking for online, there are specific brokers who focus and deal with online. And that also kind of trickles down to, how you finance these things, right? So how you can finance them is, it used to be SBA loans were a little hard to come by. About 8 to 10 years ago, they opened up the restrictions a little bit because they realized that were going to retire in the next 20 years. And they had to make it so that, and this is still happening. This is happening right now. The baby boomers, is they're transitioning their businesses to a younger generation. And the way there's a lot of different ways to structure it, but the most common ways is probably through an SBA loan where you can put 10, 15, 20% down, probably similar to a multifamily where you're putting 20, 25% down and you're leveraging the rest. These are the valuations on a lot of these businesses are going to be about a 3 to 4x their profit, their EBITDA or their seller's discretionary earnings, or however, it's mentioned. So it's going to be a little bit different numbers when you're dealing with multifamily and real estate. And a lot of it is because it's a little bit riskier asset. It has the ability to pay off a lot more cash flow and have a lot more upside. But it's a riskier asset in that sense of, your apartment complex that you acquire, it's not really going to go away. You could have a downturn in that little region or in that city or in the region of the US, and it could hurt renters and their ability to pay. But for the most part, that building is still going to be there. And even if it catches on fire, well, you have insurance for it and they'll build you another one. It's not necessarily the case with businesses. So your return is significantly higher, but so is your risk. And one thing that, Anthony, you and I have talked about is, whether you're a passive investor or whether you want to be active, whether that be in real estate or your business. And it's very, very similar with the business that you're acquiring. For the most part, you're going to be a lot more active in that business than you are going to be passive. And if you wanted to be passive as an investor, you could put that money into like a fund or something like that, similar to what you would do with real estate.
Sure. So how are your deals structured right now? So if we found an internet company we liked and it was valued at 3 to 4 times EBITDA, let's say it's $1 million in EBITDA for 2020. How do you go about putting that deal together?
Yeah.
Obviously, you talked about the SBA situation with financing. Are there other alternatives to the SBA? What does that look like? And how about
Yeah.
the equity side? Yeah.
Yeah, let me walk you through maybe that scenario right there. So say it's doing, I think you said $1 million in EBITDA. So
Yeah.
when it's doing about $1 million in EBITDA, you're going to get a little bit higher multiple, right? Than if it was saying 200,000 or even 100,000 in EBITDA, just because of the sheer volume. And, something doing $1 million in profit going to zero is significantly less likely than something making, $250,000 a year in profit. So you're going to pay a little bit higher multiple. You'll probably be about a 3.5 to 4.5x on that. So, $3.5 to $4.5 million is what you do for that. Now you can borrow up to $5 million with, say, the SBA. So, now I'm not a banker. I've done SBA loans before, but typically how you structure that is you're going to put anywhere from 10 to 20% down. You'll typically have a 10% carry for the seller, like a seller note or seller financing, and then you'll finance the rest of that price will come from and that's kind of one way to structure it, Anthony. That's probably the most common way. There are other, say searchers or people who are looking for businesses that are focusing on much larger acquisitions. And that's where you're going to have a lot more debt. You're going to have a lot more investors. And that you even have some convertible notes that are kind of baked in there. I would say most people that are kind of looking to acquire a company, Anthony, are going to look for companies that range between $500,000 and maybe $2 million in total enterprise value and sale price. And the reason for that is once you get above maybe say 3 million, you start competing with private equity groups. And that's just it's a tricky space to be in, and you have to really know what you're doing. And it's harder to close those deals, where in reality, if you're just trying to provide an awesome lifestyle for you and your family, or you and a partner, you can acquire a $2 million business that's making $600,000 to $700,000 a year. Have plenty of room left over for your debt, still take a nice salary, and invest a lot of that money back into that company to grow it further. So I would say you're probably going to be in that $1 to $2 million range is kind of the most common area to play in to avoid, the private equity space.
Got it. That makes a lot of sense. So you're specializing in the middle market is what I'm getting out of this conversation.
Yeah.
And as far as the businesses go, for real estate, we're always looking at different return metrics, right? So internal rate of return. We look at multiples too, for sure, and they're becoming a little bit more common. How about cash on cash? Do you look at that metric from a business perspective?
Yeah, absolutely. So let me give you one example. So we're acquiring a company right now, and we're putting 15% down. I say we have a partner on this deal who has a very complementary skill set. He's a developer, and so he brings all the skill sets that I don't have, and I bring the sales and marketing side to it. We're putting 15% down. But the way this cash flows, we should make that 15% back within about 10 to 11 months. So pretty quick, you're making your money back within the first year most of the time. And if you just kind of do that simple math, say for example, I always use the math for $100,000 profit. So just because it's easy numbers. So it's doing $100,000 a year in profit, and you buy that business for say 300,000. You're paying a 3x for that business, and you're putting, 30 to 50% down, right? So that business is making $100,000 a year. About half to a little less will be going towards debt. So you're going to be left with like $50,000 to $60,000 a year. And if you think about, you put 45 to 50,000 into that business, you should make that back the first year. And you can do that in salary. You can, sign you up, right? You can put that back into the business and grow it. And one of the things that I find really interesting with actual businesses is you can control a lot of the value when it comes to your business. So have additional partnerships, you can essentially increase the asset value of that business. And when you think about multiples, it's everything that you're doing is multiplied by 3x. For every dollar of profit, someone's willing to pay you $3 for that. So in this simple example of say 100,000, this is a small deal. You probably don't want to look at the $300,000 range unless it's a side project, because there's just not enough money being kicked out to really pay yourself and fund it and that sort of thing. But I do it for simple math. that if you've got your $100,000 a year business and it's, you can buy that thing for 300,000, a lot of these businesses should grow anywhere from 20 to 50% a year, right? Just because they're small businesses, they should have some pretty significant growth. And if you're growing at 20% a year, you'll double in about 4 years. So 4 years later, that business is now doing $200,000 a year. You take the same multiple and now it's worth 600,000. And so you can double the asset value by actually increasing the different levers that you have, whether it be increasing marketing and the profitability and new partnerships or streamlining certain things.
Interesting. So very similar to real estate, we're always looking at the net operating income, which is your revenue minus your expenses, and we're always trying to figure out a way to decrease the expenses and raise the revenues. And then it comes down to, mostly it's driven by cap rate. So, every dollar you save or every dollar you increase the NOI, someone's willing to pay you a certain range of cap rate, and that increases the value too. So it's very, very similar. I'm very, very curious about this. But we're gonna wind down the show a little bit now. Can you talk a little bit about your podcast and how people can find you, Ryan?
Yeah, you bet. So it's called Let's Buy a Business. I started about 6 months ago, and we've had some pretty incredible traction. And Anthony, I started it because I wanted to just document the process of a company. I've done this a few different times, but I feel like a lot of times when people do real estate transactions or they buy companies or these big life-changing events, it's done in a silo, right? So you and your closest 2 or 3 friends know about it. You know the intimate details and stuff. And so I just decided to open it up, and I kind of document the whole process, what companies I'm looking at, how I evaluate them. Now I do sign NDAs, so I can't tell you exactly what the company is, but I can tell you kind of generally what they do, the profit, the upsides, the downsides of these particular deals. And as we close on this first transaction in the next 2 weeks, our date to close is actually October 5th. We're going to open it up and show everybody exactly what we're doing and kind of document that throughout, because I do feel like a lot of people would actually do really well working for themselves, and they do really well being an owner in a business. And of course, they have that financial upside and the financial independence that comes with owning your own business. But they don't want to eat ramen noodles for the next 5 or 10 years, or they don't have the next really great local businesses in whatever area you're in, or online businesses, whichever route you go, that would be really amazing and life-changing, but you don't have to go out and start the next Google. And so you can have a really awesome $1 to $2 million a year company, have an incredible lifestyle, take your family to Hawaii or the Caribbean every year, and have plenty of money left over to kind of build that lifestyle.
Excellent, Ryan. And then, so how can people find you the best way?
Best is through LinkedIn. So Ryan Condie. I'm pretty active on LinkedIn, or letsbuyabusiness.com, or just on the podcast, Let's Buy a Business.
Awesome. Thanks, Ryan, for coming on the show. I really appreciate it. This is Discovering Multifamily, and hopefully to have Ryan back on again soon after he releases his case study. That'll be an interesting presentation, I think, for our listeners. So, Ryan, thank you so much again for coming on the show.
Thanks, Anthony. Appreciate it.
All right.